A very warm welcome to everybody to our first week ahead video for 2021. Now, there is a lot to talk about, so I'll jump straight into business. And what we'll do in today's week ahead video is take a quick look at the major market themes as we start the new year 2021. And after that, we'll take a quick look at how that is expected to impact the various asset classes throughout the year. Now, after scouring through almost 50 different global market outlooks for 2021, it's clear that the two biggest themes in terms of market themes for 2021 is firstly a global synchronized recovery and then also the debate about inflation. Now, starting with the first one there, one of the biggest themes that has really been driving asset prices for the biggest latter part of 2021 has been the overall consensus view that there will be some form of a global synchronized economic recovery, similar to what we had back in 2017. Now, the expectation of this global synchronized recovery is really driven by a couple of factors. Firstly, even though each and every single country was hit differently by the pandemic, and even though we've seen various drops in GDP differing from country to country, it has meant that economies across the world went through a massive slowdown and recession at the very same time. And due to that, they are expected to recover, or rather continue the recovery we had from 2021 at the same time, but obviously it will happen at different paces and at different magnitudes. Now, secondly, the mass vaccination programs expected throughout 2021 on a global scale should finally see some form of normalcy returning, and that is expected to really see a boost in consumer spending as consumers will become less and less concerned about the virus, about following their normal spending habits, and obviously there's lots of still pent-up demand expected to play out in 2021 as consumers start to basically come out of hiding, so to speak. Thirdly, even though the vaccines will provide lawmakers, companies, consumers, and of course central banks with more hopes of the future, it won't be enough at this stage to change the ultra accommodative fiscal and monetary policies that was put in place in 2020, and that should continue to act as a tailwind for overall economic growth. Now, interestingly, despite the actions that we saw from both the Federal Reserve as well as the US government on the fiscal side, the consensus view among majority of market participants is that the rest of the world will basically outperform the US in terms of growth, with emerging market economies expecting to see the biggest boost in GDP. According to JP Morgan, they see the US GDP set at 3.3% for 2021 versus 8.6% for China, 4.6% for the EU, and 6.8% for emerging markets. Now, that is very important to keep in mind, especially as we look towards equities as well as commodities and currencies in 2021, but we'll get to that a little bit later. Secondly, then talking about reflation. Now, arguably, a great deal right now depends on whether the market's current anticipation for high inflation actually materializes in 2021. Now, the size of the massive amount of fiscal as well as monetary policy stimulus that we had in 2020 has really given rise to expectations that we might finally start to see that stubbornly low inflation that's really been in place in the developed world for the last decade, to finally see that subside and finally see higher inflation taking hold. Now, to some extent, inflation should already be expected to rise in 2021, and that's purely based on the lower base effects that we have back in 2020. So part of that should already see inflation moving higher. But what markets are expecting here in 2021 isn't really just a base effect rise in inflation, but more a possible regime change in high inflation due to the vast amount of reflationary policies that was introduced by governments and central banks around the world. So for some, the actions of policymakers to do whatever it takes does mean that whether we see higher or lower inflation in 2021 shouldn't really be that big of a deal changer, especially if we think of things like, the average inflation targeting policy set in place by the Federal Reserve. But the thing to keep in mind is that whether we see higher or lower inflation, even though it shouldn't really be a big game changer or deal changer from a central bank point of view, there's going to be huge implications in terms of actual implication for various asset classes. So what does these two themes, that global synchronized recovery as well as that reflationary environment, what does that mean for the various asset classes in 2021? Now, we've already seen a lot of that being played out across asset classes in the latter part of 2020. In terms of the FX space, the big focus, of course, was the demise of the US dollar, which dropped more than 6% in the year, despite the fact of having that massive jump to the upside that we had back in April due to the pandemic fallout. And the other great focus point has been emerging market currencies, especially the Chinese yuan, which has really seen a lot of appreciation versus the US dollar. Now, what is expected for 2021 for these particular trends? Well, the dollar short bias is arguably one of the biggest consensus trades at the moment, and it is expected to continue. But the one thing to keep in mind that it is also one of the biggest oversubscribed positions or trades or consensus ideas in 2021 or going into 2021, according to a recent fund manager survey by the Bank of America. Now, the trend for the dollar remains lower for a couple of reasons, really. Firstly, the two major market themes, as we mentioned, that global synchronized recovery and reflation environment, that's really bad for the US dollar due to that counter-cyclical behavior that we normally have for the greenback. And it's not really favorable in a reflationary environment specifically, with the expectations of overall economic outperformance in the rest of the world versus the US. Now, these two factors has really seen a tremendous rise in risk appetite as well. And of course, as the world's reserve currency, as well as the safe haven, whenever we see that big increase in risk appetite, that's normally a key driver for dollar downside. And that is, of course, what we had playing out in 2020 and expected to still play out in 2021. Secondly, the steady rise in US inflation expectations specifically, as well as the Fed's commitment to keep short-term rates low for a very long time, means that the dollar's previous advantage that it had from a real yield perspective and a rate differential perspective has really eroded quite a lot, and that is expected to basically worsen as long as inflation expectations continue to rise. There is, though, some like JP Morgan that has argued that that damage from purely rate differential point of view has been done in 2020, and they don't really expect that to be a key driver for the US dollar going into 2021. But of course, that really does depend on what happens to real rates in terms of higher inflation expectations or not. Thirdly, another reason why the dollar is expected to continue lower is the US government has basically thrown caution to the wind with their fiscal packages, which has piled up a ton of debt, basically push back the US fiscal deficit very high. Now, given the widening deficit and that pile of new debt, the Fed would likely allow things to basically run out for some time in the economy and inflation before risking another taper tantrum like we had back in 2013. So all in all, it seems that further declines in the dollar is definitely still on the cards, especially versus currencies like the Chinese yuan, where the PBOC has basically allowed the yuan to really strengthen quite a lot. And we also have favorable yields on the Chinese bond side, which also should see some further capital inflows supporting the currency as well. Now, a possible threat to the view of a lower dollar is if we do see unexpected higher growth and inflation in the US compared to the rest of the world. Now, that could cause markets to get a little bit jittery and possibly start to rethink something like a taper tantrum. But again, where we are right now, that's definitely not on the cards. Another risk to the US dollar downside view is the fact that it's one of the biggest consensus trades right now. And that doesn't mean that it's suddenly just going to stop going down, but it does mean that the odds, the probability of violent pullbacks as well as massive short squeezes are definitely on the rise. And that, doesn't mean that, again, that the trade just stops working, but it might mean that given the extent of the drop that we've seen already, that massive aggressive downside might be waning, and we do want to be careful of not jumping in and trying to chase these moves lower. One way that we'll be looking at the US dollar in terms of opportunities is similar to that of what we see in equities, with the markets looking for better value plays. And on that front, one that we'll be watching in 2021 is the US dollar Turkish lira, which compared to a basket of EM currencies, it's got a lot of catch-up potential, especially after President Erdogan came out promising that he'll allow the central bank more freedom in their decisions. If that keeps up and we start to see more positive moves from the Turkish central bank like we had back in December, then there's definitely a lot of catch-up potential for something like that. Definitely one to keep on the radar. Looking then toward equities, focus is going to be on rotation. There's been that TINA, or there is no alternative view in place for the markets in terms of equities, where the markets are expecting from a yield perspective that there's really no alternative in terms of returns for other asset classes compared to equities. So equities overall are expected to continue that recovery that we've seen from April 2020. However, there's a few key rotation themes that we are looking at right now. That's a consensus view. Firstly, is the idea that due to expectations that the global economy is moving into a early part of a post-recession recovery, that beaten down value and cyclicals, things like financials, things like materials, should outperform things like growth. And the second rotation theme to keep track of is a possible shift from overweight US equity exposure to more attractive non-US equity places or exposures like Europe, like Asia, like other emerging markets. This is especially true in terms of valuations. Valuations are really skyrocketing in terms of the US. It's more reasonable in places like Europe, more reasonable in places like emerging markets. And of course, there's higher dividend yields compared to some US equities. Now, some investment banks like JP Morgan are expecting EM equities specifically to outperform developed world equities by about 20% in 2021. So that's really a key theme to keep in mind. But as we like to focus or stay focused on more developed world equities, something that we will be keeping a very close eye on in terms of non-US equities, and something that does carry a lot of exposure to value as well as cyclicals, is something like the FTSE 100, especially now that we have a Brexit deal that has been secured. We do see there is some scope for potential catch-up once again from a value play point of view in something like that compared to just US equities. However, keeping in mind that these rotation themes are really the market trying to cherry pick the biggest movers as opposed to just picking winners and losers. Equities across the globe are expected to continue pushing higher on the back of those two major market themes, which is global synchronized recovery as well as high inflation. And the fact that, the Fed is expected to keep rates low for a very long time, accompany that by high inflation, it means that the outlook for suppressed US real yield should keep on supporting US equities as well, despite those rotation factors. And analysts at JP Morgan still expects the S&P 500 to reach 4,400 by the end of 2020, which isn't really that far away, really, given the moves that we saw back in 2020. Now, there are some analysts, of course, as always, saying that things have gotten a little bit too positive too quickly, and equities are due for some big corrections. That means markets might be a tad more sensitive to bad news because a lot of good news has been priced in. But given that themes going into 2021, with December out of the way, with quarter and yen rebalancing out of the way, wobbles in the equity markets, if we do get them, any type of 10% or 15% sell-offs, which is normal in a very strong bull market, all of those types of downside moves are expected to be met with very willing buyers and will arguably be seen as buying opportunities. So do keep that in mind. In terms of commodities, as long as the dollar's downside continues, as long as inflation expectations are on the rise, another key market to watch and keep track of will be commodities. We've seen massive moves already in 2020 in commodities like silver, in commodities like gold, like copper, like iron ore. It's really been phenomenal. So expecting those trends to stay intact as long as the dollar keeps pressured, as long as inflation expectations rises. In terms of oil, it's been a favorite trade of ours at the end of 2020. With OPEC still expected to keep the existing supply agreements in place throughout the year of 2021, and with that big reduction in production facilities after the COVID crash, and as well as reduced expectations of capex, the overall bullish bias for something like WTI as well as nat gas does remain intact and tilted to the upside as well in 2021. And if you do get the dollar right and inflation right at the same time, you're going to have a good time getting commodities right. So we know where to put your focus if you are very keen on gaining some more commodity exposure going into 2021. Then turning to the bond market, given those expectations again of global synchronized recovery as well as high inflation, fixed income or government bonds, especially on the developed economy side, is expected to continue losing flavor among investors, and that should see steeper yield curves going into 2021, with overall forecasts putting the US 10-year between 1.2% and 1.4% by the end of 2021. Now, some analysts have called for the possibility of seeing much higher jumps in inflation than the markets are currently anticipating. And if that should happen, of course, that does run the risk of seeing much higher US yields on the back end of the curve, like the 10 years and the 30 years. But, looking at things like possible tools from the Fed, like yield curve control, that's still in their arsenal. They haven't used that. Runaway yields is probably not going to be on the cards for 2021, but it will be something in the back of investors' minds. So guys, hope that this video has been helpful, looking at the major market themes as well as the potential impact that we're expecting that to have on the major asset classes going into the year. As always, any questions, please don't hesitate to let us know.